Good morning, good afternoon, good evening, everyone. This is a market update for November 27th, 2022. Right now, I'm showing the S&P futures for Sunday. The session will be open in about an hour. That's around 6 o'clock p.m. Eastern Time, 3 o'clock p.m. Pacific Time. Last week, we had the S&P consolidate here, and we're looking for a big move because of the potential gap in the SPX and SPY. So that gap is around 3,829, and this does look like a daily bull flag trying to break out above the 200-day moving average on low volume. So we're not quite sure if this is going to break out in a significant way, and this is not like the best time to be loading up because once it breaks or fails to break, then it could go either way and consolidate again. But what I want to look here is just some of the clues of what's going to happen next. And if we draw like a simple trend line from here to like, I don't know, here, you can see that there's a potential overshoot if it pushes through 4,061, which is the 200-day moving average on increasing volume. So if the volume comes in strong, which there is a probability, not anything's possible, but the probability is in the favor of a breakout, you will see the VIX signal a risk on trading environment. That's when the VIX is red. And then the volume will start increasing, pushing the price of the S&P E-minis up through 4,061 and overshoot. And then it's probably going to tag that trend line. So that trend line, points of contact, there's about, I think, 3 so far. And then this will be the 4th attempt, which could actually push through 4,100, okay? Now, there's no easy way to trade this other than sticking with the plan or using some of the indicators that you are familiar with using. But right now, when you look at this closely, you can see that it closed with somewhat of like, if you use candlestick analysis and you're familiar with some of the candlesticks, you can see that on a half trading day, looks like the bears were in control. And you could get a possible pullback to retest that 6. If that 6-day moving average holds, there's going to be people buying there, right, looking for a bounce. The sooner that it gets there, then the higher the probability that it'll bounce from there. But if it takes the whole entire day to retest that 6-day moving average, most likely the momentum is going to follow through to the downside. And then you can see the next moving average below being targeted for another leg down, and then the gap that is around here. So let's look at the SPX, and you can see with the gap finder, you can clearly see that where your trading levels are going to be. So yeah, we can, if you look at the MACD here, you can see that there is an overbought condition once it made the first attempt to break through the 200-day moving average in the month of November. And then you can see that the momentum has subsided, although looks like, yeah, it did look like it made another high, a higher high on lower volume and lower momentum. So if it does not push through and break out, right, and then that means that this gap which had support at around 4,057. So that would probably be around 4,057, or actually the support would be just kind of like right around here. You can tell because that's where price broke through after the initial sell signal. Okay, so that's where it's consolidating. So there's a probability that it could push out and overshoot on lower volume and momentum. That would be a time to buy puts, right? So as long as the volume doesn't exceed the previous histogram here, then most likely there's going to be a little bit more weakness, and then possibly even retest the 21-day moving average at 3,900. Okay, keep in mind this 21-day moving average keeps on increasing even though price can continue to move lower. Okay, and then it will be selling off in at a rate where this MACD, fast MACD, starts to push through under the slow MACD, creating an oversold condition, kind of like what you see here. So if you look at the oversold condition that was signaled here, once the fast crossed over the slow, it didn't move any lower than in a situation that we saw previously when we had the massive sell-off in September and October. It actually held above the zero line, and then made a higher low to push it up toward the 200-day moving average on that CPI report, with the PPI report following through with lower momentum. Okay, so there's a lot of opportunity to make some pretty big trades this week. One is SPX. Always SPX, these are pretty risky, so you don't want to be super leveraging. I mean, you got to use, for smaller accounts, one contract is good enough. Way out of the money, like at $1 to 50 cents, if you're able to catch the dip. Otherwise, keep it single within your risk tolerance. But this week I'm looking at Tesla. So Tesla has a pretty interesting, it had a really big move. Didn't quite catch it because I was kind of focused on the Netflix position that I closed on Friday, and didn't want to hold onto the position over the weekend because it's just a long weekend. And then let's take a look at the setup here. So, and I'm going to use actually the volume bar indicator. That would be this one, cumulative volume delta. And this cumulative volume delta is basically all the volume that's being represented here in the histograms being displayed as candlestick plots with respect to a Bollinger Band. So this keeps it really easy to understand about how the volume is moving with respect to volatility. And on Wednesday into Thursday, there was a significant move in Tesla. So I chose Netflix. Both on the TGIF server, we had 2 TTM squeezes on the 30-minute time frame, both in Netflix and Tesla. I chose Netflix because Tesla's just got, it's just the news is just like out of control, right? We don't know exactly what's going on, but there was a significant move in Tesla, which actually was pretty clear on that candle right there. So if you're familiar with the candlestick patterns, you can see there's the sell-off and the massive sell-off that came in on Wednesday, and then you get that close within that Bollinger Band. So whenever you have something like this, kind of like what you saw here, and I mean that's not much of a signal, but still a valid signal. When you get something like this that's bouncing off the lower bands, you can take a long position on the subsequent at the end of the day on this candle. Okay. Now the problem here with Tesla is, even though it made a pretty big move, that's like about 10%, 12% move in literally like 2 days, especially if you caught it right at the bottom. But the problem here is that Tesla closed red, and that represents bears ended up with control on the Friday, but keep in mind Friday was a half day. And what can happen here is that, so this volume, this candlestick here and the volume is not really representative of a true single day, right? So this daily candle is not representative of the actual trading day that's around 6.5 hours, right? Excluding the pre and post market daily activity. So what we can see on Monday is that if Tesla drops, like this is kind of like the plan here. We have, so the market's not giving us free money per se, because it's always creating these awful gaps that we have to kind of understand what's the type of risk we want to take. And the risk here is that we have a gap at 171 that everyone can see, right? And then if you look on the intraday time frame, you can see that there's a whole bunch of gaps above it. Okay, so there's the 171 gap, 170.03 gap. And then you got a gap here at 193, which actually coincides with the 21-day moving average. Let me just go back there again on the 30-minute time frame. So that's 193. On the daily time frame, the 21-day moving average is at 197. Okay, so that means a possible overshoot. And then you got a double top at 200, which is the psychological target. Now, yeah, so this 12% move in 2 days is ginormous. And depending on how the futures opens and then the pre-market activity that starts to populate at around 4 o'clock a.m. Eastern time or 1 o'clock a.m. Pacific time, we'll see where it opens. So obviously, if it opens above 185.38 or the previous day open, that could kick, right? But then you're kind of faced with an extended position, meaning that this green dot, which is kind of by definition how we define what a trend is going to look like, is going to be somewhere around like 179, 180, but the price is going to be at 185. So you're buying at like a super expensive, at a price that's not really reasonable. It's kind of like you're buying something that's not on sale. Now, once it goes and pulls back to the 6-day moving average, and if it happens within the first 30-minute candle, right, where they just kind of flush it, and then it kind of does that within, I guess, 30. I would say 30 minutes would be my threshold, right? If it takes the whole entire day to get there, then that's a weak market for Tesla, and then the 170 gap is going to get filled. But if they flush it hard within the first 30 minutes and it tags that 6-day moving average, then what can happen is that they'll bounce from there, and by the end of we could get a bullish engulfing candle, which would open somewhere below 182. It'll flush to tag that 6-day moving average at 179.6, thinking that this is going to go all the way down to 170 on that day, which we don't know. And technically speaking, historically speaking, something like Tesla moving lower on a Monday has happened the past 3 weeks, but that reversal candle that came off of Wednesday and Thursday's run up may have created a Heikin-Ashi candle that's actually bullish. Okay, so you can see that the bullish candle here is still showing that the centroid of the current candlestick is higher than the previous candlestick. So that's a good thing in terms of just measuring the momentum. So you don't want to be buying, like, there's nothing really we can do if it opens up at 185 and takes off, because that's really like a tough trade. We should have actually done it down here, but you can see that wasn't the easiest trade to make unless you were following the volume quite closely. But now, fast forward to present time, what do we do when we have, the probability of Tesla moving higher is about 58 to 62% right now. And then by understanding the pre-market activity, we can kind of use time, say let the first 30-minute candle complete its job, right, by getting the bears to jump in, and then bear trapping them to form a bullish engulfing candle with another green day into Tuesday that tags that 21-day moving average. So if it opens lower, so lower than the previous day close, that's why it's red, and then it runs down to 180, which I think is going to happen, then it'll move up around 4.26%. So it actually I think what's going to happen is it's going to drop all the way down to 2.23%. So that, once you see 2%, a negative 2% in Tesla, that's where the 6-day moving average and the price is going to meet. And that is the time that you want to be looking to buy into those positions if the price moves down to that level within the first 30 minutes. Once it hits there, then you're going to be holding for another 30 minutes to see if it recovers or if it continues to sell off. And you want to have that confirmation where the VIX is red, because if it's red, then the probability of the reversal off that 6-day moving average for Tesla increases in favor for you. So then once it goes down to 2.29%, it's going to reverse 2.29% to break even, and then move up and maybe even close around 4%, which would be a bullish engulfing candle. So that would be the first 4% that you'd catch, and you would figure out, depending on the number of contracts, if you open up 2, obviously you should close 1, right? And then that last, whatever position you close, say half, then you're looking for another 4 to 5% move to tag that the 197, which is going to be a pretty big profit in just like literally 2 days. So that's the idea. So this is a BLT setup where you got massive bacon, everybody makes money. We were not in these positions, and then you get this quasi-looking candlestick that's representing half a day. So depending on the pre-market activity, it's going to open lower or higher. If it opens higher, then we're not supposed to chase, because then you can see that the 6-day moving average is down here. You're buying something at a higher premium. You want to buy it at the 6-day moving average, which represents about a negative 2.2% at the 180 mark, and then start buying. If that happens with the first 30 minutes, then you want to buy those and then hold to the rest of the day, looking at the trend, looking at the VIX to see if it's in your favor. If the VIX is low, right, I think if it's low, then you're going to get that power hour rally. So I'll be looking to also try to look to trade some of those SPX calls in the last hour. However, if I'm in the Tesla trade, I'll hold the position throughout the whole entire day, and then once the position develops, say like 50-70%, I'll close off half, and then follow through with the rest, the excess amount, into Tuesday, and then close those before 10:30 a.m. Depending on what the market internals show. If the VIX, right now the VIX is showing a lot more downside, right? So if you take a look at the VIX right here, you can see that gap is in the process of getting filled. So if it starts to roll over and fill all the way down to 20, that's gonna help a lot with the Tesla moving up to $200. There's a good chance. So when you look at Tesla on Thinkorswim, you can actually see that it closed above the 8-day moving average, looking like a bear flag here. But at the same time, there's actually a small little gap. It's not being represented here, but there's a small little gap. Let me see if I can pull it up here. Yeah, there it is. You can see that there's a gap at around 186, right? And then you get the 194. So when you look at the Thinkorswim platform and you plot the 21-day moving average, 194 gap is very close to the 21-day moving average at 196. And if you can see that actually the 8-day moving average is right there at 181. So, and there's actually a gap right there. Let me see if I can hide this ATR trailing stop. Yeah, so there's another problem here. So that the gap here at 170 is representing this gap on the daily, right? So that's why it's a little bit of a problem. That does look like a bear flag right here. And I guess like I just mentioned before, once it pulls back to 180 within the first 30 minutes, then that's the time where you want to buy, assuming that the VIX is red. Okay, if the VIX is not red and it starts going green, risk off, then there's probably going to be a lot of selling pressure that's going to push the price of Tesla back under that 8 and continue to show selling pressure all the way down into for the whole entire day on Monday, and possibly filling that gap on a Tuesday. And then you get that turnaround Tuesday after the gap fill. Okay, so you can see that this is not going to be an easy trade. There's lots of gaps above 186 to 194, and there's a gap here at 170. So that would represent, that's a 7% move, and then if it goes lower, That's the 7. So 7% either way. You can actually even put like a put and a call. I don't know if that's really the best, because we don't know exactly where it's going to go first. I would just stick with the long calls, especially between Friday, Monday, and Tuesday. Now, after, let's assume that it does move up to the 21-day moving average, then I think that will be a strong level of resistance, and then it'll probably roll over and fill that 170 gap. And I think that's going to happen on Thursday or Friday, which will be a pretty ginormous trade if you take those 0 DTEs. Okay, so yeah, I was going to go for Netflix. Netflix is not really showing anything on the 78-minute time frame. Neither is Tesla showing anything on the 78-minute time frame. S&P is showing something on the 78-minute time frame after slowly selling off on Thursday into Friday, and it's still, you can see that it's kind of vulnerable for a pullback to the 6-day moving average of 3,999. That if the VIX starts, the VIX is showing that it's in a clear downtrend, so the assumption is that it's going to continue moving and filling that gap. Once it fills that gap at 20, that's probably the time where you want to buy some puts. Okay, but right now VIX is not showing that. On the close for Thursday and Friday, we got some kind of difficult, inconsistent readings in the trend. Trend hit 1.57, so it is showing that there's a likelihood for the market to kind of open up green. And then the put call ratio is actually extremely low at 0.66. So that means that there's a lot of people, a lot more call buying than put buying, which is increasing the probability of a market pullback. However, it's not at an extreme level. Okay, so 0.66, I would say 0.5. Okay, when you get the puts and the calls at near at the 0.5 range, so that would be the time to consider unloading and not thinking to go too aggressive on the long calls, but to even actually position into long puts for a nice little pop to the downside. Okay, so that pop will be represented in the put call ratio, where everyone is now aggressively in puts. That's where you close those positions, and then eventually it'll just wither down later down to 0.5 again. Okay, so that's pretty much it. I'm not really looking to get into other positions. Like Apple had a pretty nasty day on Friday, and it does look like it pulled back close to the 21-day moving average. And actually you can see that it's made a higher low on the sell-off on Friday, and if it reclaims that 6-day moving average at 150, then you get a short squeeze through 154. You want to get the position here at 150. Once it gets there, hold, maybe buy a week out for a push up to 154, and even up to like 160 within 2 weeks. Alright, so I hope this helps. I'm not looking for any significant trade. I did post some other trades like Adobe on the weekly time frame, showing a pretty bullish setup into December and January. Otherwise, I'll be looking to trade, looking to see what happens with Tesla on Monday and Tuesday. Thank you very much, and enjoy the rest of your day.